Good morning and welcome to the 19th Annual Market Outlook here for Bender Commercial. I'm Michael Bender, one of the partners here at Bender Commercial. And on behalf of my other partners, we're very pleased that you're here. Every year we like to do this, and we hope it's beneficial to all of you in the business community. So we really do thank you for being here. Before I get going, I do want to acknowledge a couple of organizations and thank them for their participation in making not only this program a success, but also our community. First, I'd like to thank Kello TV. KELOLAND Media has been our media partner for 3 years now, and Angela Kinnicky's here somewhere, I'm not sure, there she is, and she's been reporting on this. They are live streaming this again this year. Last year, while you were here, some 300 folks, there was about 800 others watching it on the live stream. So you're welcome to go back on Kello's site and look at this again if you want some more information. So thank you, Kello, for your involvement. Another organization that I just want to acknowledge and thank is Forward Sioux Falls. Many of you know what Forward Sioux Falls is. That's an organization made up of all of us, and their goal is to make our community a better community to live, work, and play. And they are in the midst of a campaign this year. Every 5 years, they ask all of us to invest in our community. I know our firm has invested for 15 years now in Forward Sioux Falls. And I would encourage everyone in the room to consider an investment in that organization. It's a wonderful organization, and they do a great job. So I want to thank them for their involvement in our community. Finally, I want to thank the City of Sioux Falls. Most specifically, the Planning Department, Mike Cooper, Jeff Schmidt, and their group. We are in front of them very early in the year asking for information. Oftentimes, they're not ready to give it to us. So we're trying to get information for this presentation. And quite frankly, they're very patient with us. And we've been doing this with them for 19 years. So I just want to acknowledge their involvement and the information that they give us and thank them as well. Well, if you were to peer into the U.S. economy and identify just one indicator as to the health of the U.S. economy, what would it be in early 2016? Dow Jones Industrial Average? GDP? Unemployment rate? In fact, I believe the most important indicator of the health, both short-term and long-term, of our economy is that of productivity. Productivity, as you know, is the output of our economy, which is the GDP, measured by the number of hours required to put that output out. And let's look at how productivity has done the last few years. You can see after 2009, we had a nice run-up of productivity in 2010, and then we immediately settled right back down into the sub 1% in productivity gains in our economy. In fact, last year in 2015, we were about 0.6%. Let's look a little bit longer term now at some historical trends on productivity. Last 5 years hasn't been that good. Last 10 years really hasn't been that good in productivity gains for that matter. You know, there have been decades past where our productivity gains in our economy have been 4, 5, and 6% gains for the whole decade. In fact, there's been years past where the productivity gains were 12%. So you can see if we've only done about 1.5% productivity, we are falling behind the economies around the world, and so that's concerning. Now, maybe there is something to this that it's just harder to measure productivity in the digital age. You know, for me, it's difficult to see the productivity of, say, a new digital app versus, say, the invention of the internal combustion engine. Well, ironically, it took a decade, if not 2 decades, for the internal combustion engine, some 80 to 100 years ago, to see productivity gains in our factories with that engine. So are we in that same period now in the digital age where we're not seeing necessarily the gains measurable, but we're seeing the buildup of those productivity gains? I don't know, but I will tell you that that is a great concern that we're having with the lack of productivity in our economy. Now, there are some effects to this lack of productivity, both positive and negative. Certainly on the negative side, as we lose productivity, there's less capital investment going forward, and that's going to cause long-term negative effects to where we're going as an economy. Short-term, however, in order to output the same amount of productivity in our GDP, we need more people to do that. So we're getting employment gains. And so clearly the employment market is far better today than it has been, but it's as a result of poor productivity. So it's one of those things to be watching as you're going forward. It's kind of one of those areas that's hard to measure, but just keep it in mind as you're thinking about the economy going forward. Well, let's shift gears a little bit and look at a more kind of traditional means of measuring our economy, the GDP. And this chart shows you quarter by quarter the GDP, and you can see it just bounces up and down. These are annualized quarter by quarter numbers. Look at that second quarter last year. You can see almost a 4% run up in the GDP. Most economists predicted a much higher GDP for the year, and look what happened by the fourth quarter. We whimpered into the year with a very low GDP, less than 1%. We ended the year, however, at about 2.4%. Not bad, quite frankly, for GDP at all. That's not a bad number at all. This is a breakdown that I want to show you of the four components of GDP, and what I want to do is focus on the two top components. As you know, our society and our economy is predominantly a consumer-driven economy. And I want to focus on the consumption and the investment slide. So let's look at consumption for a second. Consumption in our economy is durable goods, non-durable goods, and services. And that's what makes up that slide. So 70% of our economy last year was in consumption. Now, on the heels of a very positive consumer confidence in the American society, I think primarily driven by lower energy prices, you're seeing very strong consumption right now in the GDP numbers. And it looks as though in 2016 and 17, you're going to continue to see very positive growth on the consumption side. So as you can see earlier, that makes up a majority of our overall growth of our economy. So that's a very good sign going forward of the strength of our economy. The other sector that I want to show you is the investment sector. And that's broken up into business spending and investments and then housing starts. And I'm focusing just on the housing starts here. You can see that we paid the price of that run-up of over 2 million housing starts for several years in a row. We paid that price in 09, 010, and it dropped down to 400 or 500 units in this whole country now. And we have slowly worked our way back up to that 1.2, 1.3. The projections are about 1.4 million this coming year. That is more historically what our averages have been. So another indicator that we, although it took a while, we are much healthier than it feels out there. So let's look at kind of some conclusions. Most economists that I've read and most of the charts that I've seen and studied have indicated that our GDP for 2016 is going to be around 2 to 2.5%. I tend to probably default on a little bit of the higher end, so I'm kind of saying around that 2.5% growth this year. Now, I would tell you, though, to take that with a big grain of salt, because these are economist projections, and as it's been famously said many times before me, that economists have predicted 11 out of the last 6 recessions. So who knows whether or not this really is going to be the number. But what I really want to show you is the economy on the U.S. level is much stronger than you think, and just pay no attention to the stock market as you see those gyrations. Let's shift gears a little bit now and talk about some trends that I see developing as they relate to real estate here. And as you hear these trends, think about how they may affect the Sioux Falls market, because these are obviously national and global trends. The first trend I want to talk about is urbanization. For the first time in our nation's history, we have more people living in urban environments than rural environments. Now, this has created wonderful opportunities for the private sector to build housing, to build retail, to accommodate that shifting demographic base to an urban environment. However, on the other side of that equation, it's put enormous pressure on the public sector to build infrastructure. There's more cost associated with urban housing and urban development. The private side is asking the public side to come along with them. So there's going to be more tension and more friction between the public and private sector as we go forward in the decade to come in this area. But watch that trend and see how it develops here in Sioux Falls as well. Another one is the interest rate. Well, we were bound to have it happen sooner or later. December of 15, as you know, we saw our first raise of the interest rate by the Fed. We've been living under the zero interest rate policy for 7 or 8 years now. I believe this is an indication that our economy is healthier. I personally think we're going to see one for sure, if not 2 more raises of the interest rate. You're going to see later on in my slides that there's possibly more inflation out there than it feels. And so I think this is a great indicator, and it's a great benefit that if they're raising the interest rate, they are attempting to slow down our economy to that 2 to 3% inflation. And that means we're hiring people, there's job growth. This is a very good slide, if you will, if we see those rates from a real estate perspective. Well, another one is the inflow of foreign capital into the real estate market. Now, there is a strong demand right now and a flight to safety. As we know, the global markets are a mess. And so you're seeing a lot of foreign capital invested in real estate. So the pressure is going to be on our bond market and on real estate. Some 60 million last year, I believe it was, 50 million last year, and it's projected to be about 60 or 70 billion this year. I apologize, billion, not million. So it's going to be about 70 billion this year. That's of about 500 to 600 billion total. So the rest of that investment in real estate is domestic. But you're starting to see a very large presence of international flow of capital to the U.S. Now, most of that is in these gateway cities on the coast. But what I want you to think about is if there's that much pressure to place this money into safe investments, preservation of capital, are we going to start seeing foreign money finally flow into secondary markets and certainly tertiary markets? So it remains to be seen, but just watch that trend and even how it may affect Sioux Falls in the coming year or so. Another trend is the retail model. And while I would say it's not broke, it's certainly in transition. Reggie's going to talk later on about retail, and you're going to hear a lot more detail about it, but it's one of those major trends from a real estate perspective that I think it's important to note. Last year, about $1.7 trillion was spent online. It's projected to be $3.5 trillion within 4 short years, double the online sales. That is rapidly changing the way we all buy things. And what that's doing is putting enormous pressure on certain retailers. So don't be surprised to see the middle market of the retail just get eroded, like the Macy's, JCPenney's, Sears. You're going to hear, like I said, more about that from Reggie here in a few minutes. And finally, the last one that I want to talk about, I think, could be the most important trend that we're facing. This is a report card, if you will, from the American Society of Civil Engineers. They put out a report card, and they update it about every 3 to 5 years. You can see we're not doing well in our infrastructure. The explosive cost of replacing our infrastructure is going to burden our municipalities and burden our state and burden our federal government. And that's going to take money away from other things. You can see we didn't have a single A in this whole report card. We had 1 B, I think, and it was in solid waste of all things. So you can imagine how well we're doing in some of those other areas. We also looked at South Dakota, and I thought it was interesting to point out that 1 in 5 bridges are structurally deficient here in our state. We're going to need $500 million for safe drinking water over the next 20 years. While we're seeing lead in Michigan right now, in Flint, Michigan, in their drinking water, we're seeing a natural gas leak in California that I think's been going on for 6 months and they can't seem to stop it. I think those are just the tip of the iceberg issues that we as a country are going to face. And I'm suggesting that South Dakota needs to reckon that too and start considering more and more dollars spent for infrastructure. Things just aren't free. So we're going to have to pay for these things somehow. So trends to watch as you go forward in the real estate business. Well, let's drive down now into our local economy. And as we always do on this, we always start with jobs, because really jobs drive our entire economy. So let's look at how we did last year. This is couched in terms of percentage growth. We finished the year at about 4.1% in job growth last year. You'll see that the years on this chart, and certainly the years that we've been doing this, this is the highest percentage job growth gain that we've ever seen in the 19 years that I've been doing this. And you can just see a really dramatic run-up in 2015 from 2014. Well, let's look at some of the other indicators of job growth and how Sioux Falls doing. Let's look at the South Dakota economy, 2.4%, very positive gains in the South Dakota economy, and the U.S. economy, 1.9%. Look at 2014. You can see there's a bit of an anomaly there where actually the U.S. economy outpaced the Sioux Falls economy. Probably the first time that's ever happened, and hopefully the last time that's ever happened. But Sioux Falls always outpaces the state economy, and we generally outpace the U.S. economy. So we're kind of aligning back into the more traditional means of job growth. But 4.1% is a big number. What does that mean in actual jobs? So let's look at that raw data now. That is about 6,000 more workers in the MSA, non-farm workers. That's a lot of jobs. I think the city announced we only grew our population by 3,800 or something, so we had more jobs created than people coming to our community last year. Who's hiring all these people? Where are those jobs getting filled? Well, we decided to ask that question and look a little deeper as to where these jobs are coming from. So we took some traditional industries, the first one being medical, no surprise there. You can see a nice run-up, about 3.8% in job gains last year. You can see all 4 years, very positive job gains in the medical environment. That still doesn't answer the question where all those jobs are coming from. So we looked at another industry, financial services, and lo and behold, we saw kind of a negative job growth the last 2 years. That 0.5%, I wouldn't be too worried about that 0.5% in financial services last year. It represented about 100 jobs. So it's not that significant. But nonetheless, it still doesn't answer the question, who's hired 6,000 people in our economy? So we looked at another industry, construction services, and we think we found the answer. You can see a really dramatic run-up in job growth gains in the construction cycle. 2 years ago, 3 years ago, very dramatic. In fact, if we put the state numbers here, it just looks too confusing to add another bar on there. But if you looked at the state of South Dakota job growth, their gain last year in construction services was 10.5% gain. So there appears to be a lot of people getting hired in construction services. And if they're trying to find people in this low unemployment environment, they're having to pay more to hire those people. So that led us to the next question, which is, I wonder if there's inflation in the construction side of the business. So what we did here is we put up a slide of the CPI in the blue, and we all know CPI represents a more traditional means of inflation. And then we put up the PPI, the Producer Price Index, and we averaged all the construction services together and created an average of the PPI for construction. Well, you can see here that construction services the last 2 years have been more than 2, if not 3 times, and almost 4 times in 2014, the CPI. So that's building inflation into our construction industry here locally. And that begs the question, will that continue, and are there jobs that won't happen in 2016 because of the enormous amount of inflation that's been built into the construction market? So let's turn our attentions to 2015 and see how we did in our total volume. You can see here that we finished the year in total permits in the city of Sioux Falls, about 676 million. I think that was the number that we had. It's a record again. Could there be some of that inflation we're talking about? Yes, but it's a record nonetheless. I really want you to focus on the relationship between the commercial and the residential, not necessarily the record. What you see is in 2014, again, we saw an anomaly where new construction in residential outpaced commercial construction that one year. Historically, that's not the case, you can tell by those bars. It's usually about 60% commercial, 40% residential. But we had a flip-flop that year, and now we've kind of realigned again to more traditional ways of our economy growing between these two bars. So let's break out that residential and just focus on the commercial construction now. This slide I put up every year because I like to see as we go into the next year whether we're entering a contracting economy or an expanding economy. If it's contracting, the addition remodel sector will outpace the new construction. If it's expanding, the opposite takes place. Well, you can see that that delta is emerging with new construction outpacing the addition remodel in a very healthy margin. It was a little bit less than that in 14. And I believe in 2016, you're going to see that same delta appear. Maybe not quite as many dollars spent overall, but you're going to see that delta be about the same, about a 30% increase in new construction on the commercial side than addition remodel. Let's break out that new construction now. The city of Sioux Falls does a great job of giving us this information, and they create these categories, and they really fit everything into 4 main boxes. You can see that purple line. That's the other category, and that huge run-up was the event center a couple years ago. You can see it's kind of adjusted back down to more traditional areas. The blue bar always leads the way, or historically leads the way in new construction. That's the office sector, and that's financial services and medical and those kind of things. Last year we predicted that there was going to be a dramatic uptick in the retail construction, and sure enough there was. Again, you'll hear a little more about that and some predictions going forward here later on. Steady Eddie is the industrial. No question, it's always kind of consistent and steady. You may very well hear from Rob a teaser about new construction in industrial this year. So we'll see what he predicts going forward for that. Let's look at some examples of some of that volume from last year. The Aquatic Center was a big one, obviously. Another Walmart. You can just kind of get a sense of what it is. All solid quality things. Most of that, I should point out, is not speculative. It is institutional. And that just an observation that you're not seeing a lot of speculative development in those larger scale projects, nonetheless. Well, we always like to compare ourselves, and this is no different this year. So what I did was I put up a number of communities to look at where we are. The anomaly this year for me was Rochester. As many of you know, Rochester is the home of Mayo Clinic, and Mayo has announced about 3 years ago a joint venture, a partnership with the state of Minnesota. They're going to spend about $3.5 billion in the city of Rochester on infrastructure and new medical facilities over the next 10 years. So on a per capita basis, they're already blowing us away. They're about a community of a third less total size than we are, and they're only 100 million less than us last year. I suspect you're going to see that number rise very dramatically the next several years for the city of Rochester. I put up Willitson, North Dakota again this year. It's probably more for my own kind of edification of, I told you so edification. But you're going to see dramatic drops even next year in Willitson. And I wouldn't be surprised. That's a town of only 25 to 30,000 people. So I suspect you'll see a much more dramatic drop even again next year as it's getting pretty rough up in the oil patch up there. So, and I don't think that's going to change anytime soon. Okay, I'd like to go next to one area in our economy that I think is of concern, and you're never supposed to end a presentation kind of on a downer or a cautionary tale, if you will, but I'm going to do it at the risk of doing it this year. There's an industry that affects our local economy quite dramatically. You probably can guess what it is. It's the ag economy. And this shows you the effect that ag has on our state economy. While there's only 2% of the U.S. population in the ag economy, 1 in 5 jobs in South Dakota is in ag. $26 billion in total economy for the state of South Dakota. So you can see the impact that ag has on our state. And it's harder to measure on Sioux Falls in particular, but you know it has a major impact on our local economy as well. So let's see how ag's doing. Well, we decided to look at farm income, and you can see a very dramatic drop in farm income 2 years running. Now, I would point out that if you take that income and take 2015 income and go backwards to the last time we had that gross income, it really isn't that bad of a number, about $1.75, $1.8 billion in income in the ag economy. What I would point out, though, is think about 29 and 2010 and those costs of inputs then versus the cost of inputs in 2015, and think of how much more expensive it is now than it was then. So the net income is very dramatic from the gross. And let's look at an indicator of that net income. What we did is we thought sales tax revenue would be a good indicator of that on equipment. So you can see a very precipitous drop in the ag spending in the economy in our state. So this puts enormous pressure on our state budget, on our municipality budgets. So they're having to fill that hole some other way because they're not getting that revenue. That's 58% drop in 2 short years just on equipment spending. Now, we'd be remiss if we didn't tie the ag economy to the real estate market. So we're in the land business, so we wanted to talk a little bit about the effect on the land business. So I created 2 chronological silos, if you will. One silo is the ag run-up with commodity prices. We all know that price of bushel, I think, got almost $8 on the futures market back during that time. It's now $2.90, maybe $3. I'm not sure exactly where it is. But we can see that dramatic run-up and the dramatic drop. Let's see what it did to land values. Now, I purposely picked Iowa. I did not pick the southeast corner of South Dakota. I picked Iowa because I thought it was a more regional representation of the ag economy. And so what you see here is a huge run-up in land values, very short period of time, and that just spells bubble. No question about it. And now we're starting to see them come down. Although they haven't lost all the gains they created in 3 short years, they're starting to come down. So the question is, in 2016 and beyond, specifically for land, how much more will it come down? But more broader than that, in the Sioux Falls economy, how much will the ag impact? Ag is a lagging indicator. It takes 12 to 18 months for ag to filter through a local economy. So how much more will ag affect our market? I don't think it's dramatic, but I do think there's serious concern in the ag economy right now. So where that filters in remains to be seen. But with that, what I want to do is kind of turn it over to Rob and have Rob lead us in through the land market, and then you're going to hear from my other partners about the other sectors, and then I'll wrap it up at the end. So Rob?
All right, thanks, Michael. With him kind of finishing up on the ag land market, it's a perfect segue into the land market. So for the second straight year, we decided to start off by taking a look at some dirt and working our way up into some physical structures and some of the other presentations. In my report today, I'm going to be highlighting a few trends that took place both in the unimproved and improved land markets. But before I do that, as always, I want to define what I mean by the land market. By our definition, the land sales market consists of 5 different property types. It all starts out as unimproved raw land, which is generally the farm ground that Michael just talked about, and surrounds the city. That's sold on a per acre basis. Now, when you start plugging in all the infrastructure, such as curb, gutter, sewer, water, etc., it becomes improved ground, which is used for the 4 other basic property types. That's sold on a per square foot basis. So to start out, I want to take a look at my report card from last year. I predicted that unimproved land sales would remain right at about the same number as we saw the previous year, that improved land sales would increase, and that pricing across all sectors of the market would increase. So let's see how I did. We'll start off with the unimproved land market. And unfortunately, for the second year straight, I was wrong on my prediction. Instead of making a lateral movement like I had thought, the total number of transactions in 2015 increased up to 8. So let's take a look at what some of those sales look like. It was really just a mixed bag of different sales, anywhere from residential developments to nonprofits, to industrial developments. Many of you heard about the big announcement this past year of Foundation Park, the 820 acres up on the northwest part of town. These sales ranged anywhere from $10,000 an acre all the way up to $60,000 an acre. Now, over the past 4 years, we've tracked where all these sales have been taking place. All of the 24 sales, with the exception of 2, have been on both the south and east part of town. So what is this slide really telling us? Well, it's telling us where developers are positioning themselves for the next 5 to 10 years of growth. And quite honestly, they're the ones who drive this whole entire market. They go buy a chunk of ground, they put together a bunch of preliminary and final development plans, and then they go out and plug in some infrastructure. Once they put in that infrastructure, they've got themselves some build-ready lots. So let's take a look at the number of build-ready lots this past year, essentially meaning I can go buy a lot tomorrow and start building on it the very next day. For 2015, we're sitting at right around 2,300 available build-ready lots. That's our supply. Now, when we look at the demand, the 932 building permits that were issued this past year, we're sitting on about a 2.5-year supply. You can see that margin is starting to narrow, but I think with those 8 transactions this past year, that's going to open up some additional lots, build-ready lots. Okay, I'm going to switch gears really quick here and take a look at what I like to refer to as the per square foot stuff. In 2015, the total number of transactions increased by nearly 50%, from 60 all the way up to 89. That equated to about $60 million in total dollars spent, 100% increase from the previous year in total dollars being spent. Let's break these down into their individual land sectors. And as you can see there, I might be covering up that green bar, but take a look at that green bar. It's no wonder why that 30 million jumped up to 60 million this past year. We had all those crazy retailers running around out there buying up all that high-priced land again, much like we saw in 2013. I don't want to take away from the office and multifamily markets. As you can see, the blue bar and the purple bar, as they both had record years in of themselves. So overall, it was a great year for improved land transactions. Let's take a look at the going price for some of these different sectors. The largest gap or spread when it comes to pricing is usually in the office and retail markets. That's because they're much more location sensitive than that in the industrial and multifamily markets, oftentimes driving up that price. And that's very prevalent in infill sites. And I'll get to that in just a second. I want to back up to my predictions that I made a few slides ago. If you remember, I predicted that pricing across all sectors of the market would increase. I was partially right. Actually, in the industrial market, we saw a 15% drop this past year in pricing for the industrial market, and then multifamily, there was an 8% drop. So doing all right on that end. Let's take a look at infill sites. I just talked about that a second ago. What are infill sites? For some of you that haven't been with us in the past and don't understand what these are, basically the land is more valuable than the structure that sits upon it. So a lot of times what we see, investors will go out or owner occupants will go out and they'll buy up these sites with the intention of redeveloping them for a higher and better use, oftentimes bringing a premium in pricing. We'll see that downtown quite a bit. People pay anywhere from $15 all the way up to $35 a square foot for the dirt itself. This past year, 2015, that equated to 15 total sales, a record number for this little subcategory. Just some examples this past year, Billions GMC down on 41st, they acquired some residential lots that they'll use for expansion purposes. Avera did the same thing on their campus, and I'm sure plenty of you heard in the news and magazines and on TV, there was a whole lot of guns, gold, and rock and roll that took out a bunch of properties up there on Russell Avenue. So just wanted to highlight a few infill site transactions, and that'll bring us right into my conclusions and predictions on the land side. Like I said, a record year in the unimproved land market, 8 total transactions. I think developers are tapped out with their available supply of some of this land. So for 2016, we'll probably see, or I predict that we'll see less transactions in that market. As for improved land transactions, another record year. Ever since 2010, we've had a slow and steady increase over the years in improved land transactions. And as construction tries to catch up to all those acquisitions, we'll probably see less improved land transactions throughout the remainder of the year. Watch for a 4th year of infill sites acquisitions. And then as far as pricing, again, the price per acre and the price per square foot that people are paying across the market has leveled off. And I think we'll see for 2016 right around the same prices as we saw in 2015 in those various sectors. So with that, I'd like to take just a minute and transition over. And Nick, do you mind getting up here and doing a little dance for everybody while I kind of get my breath here again? Okay, as you'll notice, many of you have been here in the past, and you'll notice the gentleman that usually sits over there and has the very flamboyantly colored socks, usually with a matching tie, is not with us this year. Doug Brockhouse, he decided to turn in his suit and socks for a swimsuit and some sandals down in Florida. So in honor of Doug this year, and hopefully Doug's watching this online while he's sitting on the beach, but in honor of Doug this year, every single one of us decided to go out and get ourselves some colorful socks. So hopefully we're doing them justice. But anyways, fortunately or unfortunately, you get to hear me give this presentation this year. And as Doug would always say, here comes the boring part, the definition thing. Okay, the industrial market are those properties used for manufacturing, warehousing, distribution, contractor shops, etc. Pretty much we've always said if you can get a magnet to stick to it, it's more than likely going to be in this report. So let's take a look at what makes up the industrial universe. This past year we had 22 total buildings get added to this market. 750,000 square feet is what that equated to. In Sioux Falls, we're sitting right at about 16 million square feet. And in T, we actually saw that market go from 2.4 last year up to 2.6 this year. That's about a 9% increase in that market. That's a fairly sizable increase. And I'll be talking more on that in a little bit. Traditionally, we've always tracked the split between owner-occupied space and tenant-occupied space. This past year in Sioux Falls, we were sitting right at about a 70-30 split of owner-occupied versus tenant-occupied. And in T, we were at 75-25 split. I think we'll start to see that blue pie expand a little bit as we see some spec building take place throughout the year. So I'll speak at that here in a little bit as well. Okay, what happened in 2015 in the industrial market? Well, in order to determine what happened, we have to take a look at first what was available at the beginning of the year, what got added during the year, and what remained at the end of the year. So to start off, we're going to take a look at where were we at the beginning of 2015. We had 276,000 available square feet at that point in time, a 1.77% vacancy. That was about half of where it was at from the previous year. And at that time, we were absorbing space at about 1,100 square feet per day. What that means is of that 276,000 square feet that was available, if nothing else got built, we would be out of space within 247 days. So a fairly short time frame. So that's that beginning number of available space at the beginning of the year. Let's take a look at the second number. What came online during the year? Now, you just got done listening to Michael talk about all these record building permits and record construction numbers, which is great. But unfortunately, over the past so many years that all these records have been taking place, it hasn't really converted over to the industrial market until this past year, as you can see. In 2015, new construction jumped all the way up to 537,000 square feet, the most we've ever seen in this market. So a pretty impressive jump this past year in new construction. Now, Doug always used to say that many of you come to this presentation for one thing and one thing only, and that's to look at pictures of industrial buildings. So I'm not going to take that away from you this year, so I decided to throw up a few pictures of some new construction. The one in the upper left-hand corner is what I like to call a semi-spec building. This is up on the north end of town, just northwest of the former Capital One property, if you know where that's located. This is a 30,000 square foot building that got built with a tenant in hand for a portion of it, leaving the remaining 15,000 square feet as vacant spec space. Now, directly to the east of that, both in location and on the screen here, is Republic National's new 145,000 square foot distribution warehouse. They moved out, or are moving out of their facility over in the old airport industrial park, about 50,000 square feet. So nice new building that's going up. That's right behind the former Capital One property. In the lower left-hand corner is High Roller's new 134,000 square foot manufacturing facility. They moved out of a functionally obsolete building over on West 12th Street into this beautiful new manufacturing facility and up in what we like to call the Jan's Mick development. If you know where J&L Harley's at, or Flying J, just to the south of Flying J. And lastly, we had a true spec building come up this past year. 8,800 square footer. This building just got absorbed last week by a distributorship out of Miami, Florida. So there you have it, a few pretty pictures with the snow in there. So let's take a look and run some quick calculations. What was vacant at the beginning of the year, our first number, added with what came online during the year, gives us a total available space of 813,000 square feet in 2015. Now let's take a look at that third number. Okay, so at the beginning of the year, at the end of the year, December 31st, 2015, just a little over 2 months ago, we took a look at the market, we canvassed it, and said, okay, where are we sitting today? And we noticed that we're still in that uncharted territory, under 2% vacancy in the industrial market, an extremely tight market. So of that 16 million square feet that I was talking about, 310,000 was available at year's end. You can see the T market just as tight, extremely tight down in that market, 2.6 million square feet. They only had 33,000 available at year's end. Some quick math again. Total available space, 813,000 square feet. What was vacant at the end of the year, 310,000 square feet. We had a net absorption of right around 500,000 square feet in the industrial market this past year. Now, when you compare that to 2014's number, guess what? Another record for the industrial market. We had about a 23% increase from 2014. So we're gaining some momentum in this market. All right. So where were we at? Again, at the end of the year, at the beginning of the year, I had talked about us absorbing space at 1,100 square feet per day. End of the year, we were about the same. So we had 310,000 sitting vacant at the end of the year, like I had said. If nothing else gets built, we're out of space by the 4th of July again. So as fast as products coming online, it's getting absorbed in the industrial market. So we need some people to step out and get to building. Okay, just wanted to highlight really quickly some of the transactions in the industrial market this past year. We had a drop in 2015 in the total number of transactions and that equated to about $30 million in total dollars being spent. Now, you might be asking, okay, Rob, you're sitting up here, you're telling me all about these new construction numbers that are record highs, this net absorption that's record high, all these records, and now we got a drop in the number of transactions that went on in 2015. Well, Nick will talk about it in a little bit, but owners are really wrapping their arms around all their tangible assets right now. It was really rare for us to see industrial buildings come up for sale this past year. So we'll keep an eye on that throughout the rest of the year. I predict we'll probably see even less as that trend continues. Okay, let's take a look at the health of the industrial leasing market. Traditionally, we've always kept a running average of where the rental rate has been. Instead, we thought it would be helpful to break out this year the industrial market into its building classes. So start out with Class A. We really don't have any true Class A industrial space in town. We've got a few buildings, but really not enough to show a price. So this is more indicative of a new construction number this past year. Class B, more of that second, third generation space. You see wholesale suppliers, contractors in these type of spaces. And the lower end of Class C, you're starting to approach some cold storage warehousing at that price. And the higher end, we see a lot of manufacturers in some of those older buildings at that price. So this begs the question. You know, Doug's been talking about it for years. He's been trying to get people to get out there and build. Begs the question, are we ready for some spec building? So I thought we'd run some math this year, and first off, I'll make a few assumptions. We're going to build a 15,000 square foot building, metal building, small office, bathroom, grade level door, and a dock door. And we're going to use from the previous slide the rental number of $6 a square foot. And in talking to a couple of contractors around town, it sounds like you could probably build this 15,000 square foot building for around $70 a square foot, all in, building and land. So with those assumptions, let's run some quick math. 15,000 square feet times $6 a square foot, about $90,000 in income on an annual basis. You take that $90,000 and divide it by the total cost of construction, $1.125 million. You're right at about an 8 cap. Again, Nick will highlight in his investment report where the cap rates are at today, but I'm willing to bet there's a few people out there that wouldn't be afraid to pull the trigger on a building like this. And quite frankly, we've seen some people already do it this past year, and it's been very prevalent in the T market, We're seeing spec buildings go up down in the T market. We're seeing some buildings out in Hartford, Brandon, some of these bedroom communities buildings are popping up in. So we're seeing a migration of some companies out into these areas. You might be asking why. Well, I just talked about that 8% cap, your return on your investment. That starts to increase when you can go out to these areas. You can get cheaper land a lot of the times. There's less regulations. Some platting fees that you don't have to deal with at this point in time. And quite frankly, the industrial market, these type of users are less location sensitive than that in the office or retail market. So I just kind of wanted to touch on this trend, and we'll keep a close eye on it and report on it as the next couple of years, over the next couple of years. Okay, conclusions and predictions. As I just mentioned, we continue to see growth in some of these bedroom communities. That $75 a square foot number that I talked about, 25 to 30% of that is tied up in land cost. So when you can go out into some of these areas, like I said, and buy cheaper land, and in some cases even free land, it makes it extremely tough to compete. All right, as far as sales this past year, I had mentioned we saw a drop in sales. Owners of property are holding tight onto their bricks and mortar assets, and so I think we'll see less sales in this environment for 2016, which in turn may drive up some leasing as some of these buildings come available. Instead of selling them, landlords will lease them out, along with some of the spec building that we hopefully see throughout the remainder of the year. Leasing activity will increase. And like I said, 2015, new construction numbers, record highs. For 2016, there's been some grumblings out there about some pretty big industrial projects. And if those end up coming to fruition, we'll see another record high in 2016 for new construction. Even if they don't, we'll have another strong year in new construction for the industrial market. So switching gears and taking a look at the real estate cycle. This is my first year that I get to have a real estate cycle, so I'm pretty excited about it. And taking a look over there at the expansion column, we had decreasing vacancy rates. We had high new construction, record high new construction, high absorption, net absorption, talked about that, another record high. Michael talked about employment growth, and we also saw rental rate growth this past year. So it's the first year in a number of years that we've been able to cover everything in that column. So for 2015, we're just at the beginning stages of expansion in the industrial market, and watch for that to increase as we go throughout the remainder of 2016. So thank you for bearing with me through that industrial presentation. And Doug, if you're online, I hope I did you well. And I would like to bring up Miss Anderson to present on the office market.
Thanks, Rob. First of all, I'm a little hurt you didn't ask me to do the dance in the entertaining versus Nick, but I'll let that one go. My name's Andy Anderson, and I will be speaking on the office market this morning. We've seen some growth take place over the past year, but also some really unique changes. This year, I'd like to start off with talking about the office sales. We've had over $35 million in office transactions over the past year. Now, that's well above the 10-year average, and the second highest year we've seen since 2006. But what I find interesting is when you really break these sales down on a per square foot basis. We had a range from $75 a square foot all the way up to $220 a square foot. Now, buyers that bought on the lower end typically knew improvements needed to be made to those properties, and were prepared to do that. Those that bought on the higher end were usually medical, dental, more specialized type properties, really more move-in ready. Now we're going to switch gears and look at the rental market. We have a total of 14.2 million square feet. Now, as I move forward, I only focus on the 7.5 million square feet of tenant-occupied space, due to the fact that the owner-occupied doesn't affect our vacancy or rental rates. Now, I break that 7.5 million square feet into two sectors. The first sector is the CBD, or the downtown area. The inventory really has stayed stable over the past couple years downtown, currently sitting at 2.3 million square feet. Now, interest or demand has been healthy and strong here, resulting in our vacancy rate dropping from 11.9% down to 9.3%. Now, when your vacancy rate drops, typically you have positive net absorption, and we certainly did, of about 63,000 square feet. Now, looking back, it's easy to discount the negative net absorption that took place in 2009. But what happened in 2014? Well, we had a couple of buildings with larger footprints become available. And again, demand is strong, so we did have positive net absorption in 2015, which really looks healthy downtown. Now we're going to shift gears and look at the suburban sector. This is everything excluding the downtown market. Currently, there's 5.25 million square feet of inventory. Now that's a 40,000 square foot increase from the previous year. One example was a beautiful office building constructed in the southwest side of town. This building alone added 26,000 square feet to this sector. Now, as Ricky would say to Lucy, we have some explaining to do on this slide. The suburban sector has never seen this dramatic of a spike in its vacancy rate. We went from 7.5% to 12.2%. That is a huge jump. What happened? Well, we had large blocks of vacancy become available. In our 19 years of doing research, we have never seen this much corporate call center type space available in the city of Sioux Falls. Now, we had to crunch the numbers and really ask the question, if we were to pull these three buildings out of our survey, our vacancy rate would have been sitting at 6.6%. And again, demand is strong in the suburban sector, so we did have an overall positive net absorption of about 35,000 square feet. Now, with those large blocks of vacancy I just spoke about, I predict we will see a significant spike in our net absorption over the next year in this sector. Now we're going to shift gears, and look at things as a whole. This slide represents our citywide vacancy rates. Now remember, this combines the downtown sector and the suburban sector. So it's no surprise with such a big spike that we saw in the suburban sector, the vacancy rate citywide went up as well, from 9% to currently sitting at 11%. And as you already kind of saw, the national vacancy rate did drop down to 14%, but the city of Sioux Falls is well below that average, which bodes very well. And this slide represents our asking rental rates net of all expenses. Again, this is citywide. Now, when you see the office market continue to tighten in both sectors, and it has over the past several years, rental rates tend to start ticking up, and they have. With the downtown market really leading the way, our rental rates have increased on average by about 10%. Now, as I was doing my research this past year, I really started to focus on the citywide inventory over the past 10 years. And what took place? If we take a look pre-recession, a 5-year window of time, we had a 2 million square foot increase in our inventory. Post-recession, that same amount of time, we only saw about a 1 million square foot increase. It really made me ask the question, why? What happened? Well, we certainly had excess space. High demand in office pre-recession left us with a significant amount of space. Post-recession, space was getting absorbed, but construction basically halted. One of the reasons, construction costs certainly have increased. That alone is driving developers to be very conservative with what they choose to do as far as building office space. They're requiring a significantly higher amount of pre-leasing of space before they'll ever put a shovel in the ground. And as evidence of those large footprints of buildings that we have on the market, office densification certainly is taking place. I predict that will continue not only on a local level, but on a national level as well. So where does that put us on the real estate cycle? Sioux Falls is really in kind of a unique spot, in my opinion, right now. We're certainly not in recovery, and we're definitely not in hypersupply. So for the next 12 to 24 months, I predict we'll just continue to hang out in expansion. And with that, I would like to bring up Reggie. Oop.
Thank you, Andy. 2015 was a banner year in the retail sector. Investors who own retail real estate have every reason to be confident right now. Today, my presentation will focus on rental and vacancy rates. We'll look at sales trends, We're going to focus on what I think is the story of 2015. That's the infill and the redevelopment sites. We'll look at some national trends and finish with some predictions for 2016. For the purposes of the first slide, we're going to focus on tenant-occupied space only. As we started looking at the numbers this year, we realized pretty much status quo compared to last year, and that was especially apparent around the mall in southern Sioux Falls, where when space does become available, it gets backfilled almost immediately. Another note on this slide is take a look at Dolly Farm. Last year, they were at 9.1% vacancy, the first time ever in single digits. This year, they added additional space, absorbed it, and now we're at 7.5% vacancy. The momentum seems to be building in Dolly, and I would look for that trend to continue. As far as rental rates, on the second generation product, we've seen rental rates hold steady with a slight increase. And on new construction, we've seen a 5 to 10% increase. And I'll touch on the redevelopment rental rates in just a little bit. We're going to look at some sales. Wow, $68 million worth of sales last year. This is more than double our 10-year average. This is primarily due to two very large retail investment transactions that occurred last year, which Nick is going to highlight in just a few minutes. But this is a really good snapshot view of the health of the retail sector. So we're going to switch to infill and redevelopment. And these sites, the infill and redevelopment sites occur generally when an existing structure on a well-located piece of land has exhausted its usable life. It's become functionally obsolete. There's now a higher and better use for that site. Developer comes along, buys the site, raises the building, constructs new, and primarily driven by national tenant interest. And because of these added input costs, these national tenants are paying huge numbers in rent. Let's take a look at a few examples. The Valentino's building on 41st was raised and is now in the midst of becoming a new Verizon store. The K&H Car Wash on 41st is now home to a Caribou Einstein and an Aspen Dental. The Burger King on on Minnesota is now the home of an Einstein Caribou and a Z Merrick's Noodle Cafe. And this is just a sampling. There were several others, owner occupants that got involved on 41st Street as well. Nyberg's finished their renovation with some infill in 2015. Billion Auto's been very active. Graham Auto bought the old Coyote Canyon building, raised it for a future expansion, and Montgomery's finished their renovation in 2015. And there were several other examples throughout the city. Well, one would assume with all this activity probably had huge construction numbers. You'd be right. Last year we predicted we'd get to 40 million. Not quite, we're at 38. You notice the two peak years, 13 and 15, those are the Walmart years. Those Walmart building permits were about $10 million each. I don't think that we'll sustain this next year, and I'll get to that in my conclusions. All is not rosy in retail. It is very cyclical and competitive. Here's a list of just a few of the retailers that closed their doors in Sioux Falls in 2015. But the good news, the fundamentals are so robust right now in retail that you'll notice that most of these vacancies have been backfilled within the year. Some new construction areas to watch in 2015, I think there are two of them, would be Dolly Farm and 85th in Minnesota. At Dolly, I'd look for additional restaurants, financial services, and medical office to be constructed this year. And at 85th in Minnesota, I'd like to dub this intersection Optimus Prime. This thing's going to be transformed in the next 12 to 24 months with all kinds of retail users. National trends. Retail continues to evolve. Michael touched on this a little bit earlier. We're all changing the way we shop. We're going to look at bricks versus clicks. We're going to talk about how we're shopping, what that means to real estate, and how this is primarily being driven by the millennial generation. 2015 was the year the millennials became the largest generation in the U.S. workforce, which means now they've got some money and they're going to start spending it. This first slide is really interesting. This is e-commerce sales as a percentage of total retail sales. The year 2000, not a big surprise, 1%. With all the advances in technology, 2015, it's only 7.5%. I can promise you it's a lot higher than that in my house. The FedEx man's on a first-name basis with both my dogs, and leaves them treats multiple times a week. Industry experts believe this is going to double in the next 4 years, and we're only in the early adoption stages of e-commerce. So what's that mean to real estate? Well, we're going to look at a big box first. This is for every $1 billion in sales. On the left is a traditional bricks and mortar retailer, and on the right is an Amazon model. In order to achieve that $1 billion in sales, that traditional bricks and mortar retailer needs 2.5 million square feet of very expensive retail square footage. In order to service that retail square footage, they need about 325,000 square feet of logistical warehousing. Almost 3 million square feet. Now, if you look at the right-hand side, this is the Amazon model. In order to achieve that same $1 billion in sales, they need 1 million square feet of inexpensive warehousing space. This is just one of the reasons so they can provide value with their service. What's that mean to Sioux Falls? Well, Sioux Falls is going to, we're all going to see the smaller store footprints. The average footprint's going to decrease between 15 and 20% in the next 5 years. Some conclusions, predictions for 2016. We're going to see some more restaurant concepts. That's always exciting for everybody. As I said earlier, I don't think that we're going to see as much construction this year. That we'll see plenty, but it's just going to taper into that $25 to $30 million range. There will be some infill this year, just won't be as much as we saw last year. And is this the year we see a big box become available? I kind of think it is. The primary candidates are Kmart, Sears, JCPenney, or Macy's. Real estate cycle, high rental rates, low vacancy, high construction. It's no surprise. We're at the peak of the retail market, and I look for us to stay here for the next 12 to 24 months. I'd now like to bring up our new cleanup hitter, Nick Gustafson, to talk on the investment market.
Thank you, Reggie. Doug, if you're watching, I'm wearing your socks for you. In this portion of the presentation, we focus strictly on investment transactions. We'll take a look at what buyers and sellers are thinking, how it affected 2015, and we'll make some predictions about 2016. Now, investors have many options when it comes to allocating capital. They can stick it under the mattress. They can keep some powder dry with cash. Equities, bonds, startups, real estate, of course, my favorite. Or they can reinvest in the core business that made the money in the first place. Investors have been in a low interest rate environment for a long time now. However, in 2015, they found yield increasingly difficult to find. Look at these major stock indexes, negative returns. CDs, not much better. Bonds, not good. If those gold bugs out there had a negative 10% return. Keep these numbers in mind as we look at individual real estate investments here in Sioux Falls. This graph illustrates the risk premium investors really place on real estate going back 30 years. This gray bar is the safe 10-year treasury. The blue bar is cap rates across all asset classes in the United States. The further this spread is apart, the more risk investors are placing on real estate. Investors have a healthy respect for the risk inherent in real estate. Look for them to pay more for real estate if yields continue to be low. Now, I'm going to try to answer a fundamental question for multifamily. I'm not going to go into office and retail fundamentals because Reggie and Andy did a great job. And the fundamental question is, are we overbuilding multifamily in Sioux Falls? The only way to answer that question is to look at some data. This is new unit construction going back to 2004. In 2015, after 5 years of run-up, investors pulled back 25%. Well, this really doesn't answer the question, so let's look at this in a true historical context. People often come to us looking for data, and we have data. This is new unit construction going back to 1871. Impressive, right? In the 70s, 80s, and 90s, we built similar number of units in Sioux Falls, so that doesn't answer the question, so we have to look at vacancy. Bad news. 300 basis point increase in early 2016 in conventional multifamily after 5 years of sub 5%. Well, one data point does not a trend make, but developers and investors need to be cautious doing 2016 pro formas because occupancy and cash flows may be lower than they were thinking in 2015. Let's take a look at what investors actually did last year in the multifamily market. $38 million of transaction. Great year. Second best year on record in 28 transactions, 4 units and higher. That's a 300% increase over last year. That looks pretty healthy. Let's take a look at some of these individual transactions. Village Square, $2.2 million, great property, 32 units, 7.55% cap rate. Looks pretty good compared to those other numbers we were looking at. Next up, Cleveland Heights, $6 million deal, 147 units, and that was an 8.67% cap rate, mainly due to some deferred maintenance. It was an older property that needed some work. Next up, we have actually a really creative transaction. This was a larger property, but the buyer actually put this under contract 2 to 3 years ago at a 9% cap rate. He was actively involved in the management, and when he closed in fall of last year, he actually did better than 9%. Great buy. We're going to dive into some office and retail transactions, and frankly, I'm not going to go into the fundamentals here. Andy and Reggie did a great job, so we're going to dive strictly to the cap rates. $10 million deal in 3 buildings out in Dolly Farm, $200 a square foot, and this was a 6.9% cap rate. Good investment. $6 million office sale, $150 a square foot, nearly an 8% cap rate. Next up, we have a really great buy. This was the Carpenter Building downtown, $3.5 million. At acquisition, the buyer promptly invested $1 million into this property, mainly converting a non-performing office floor to multifamily, and they saw a substantial revenue increase. At the time of sale, this was a 5.89% cap rate on 70% occupancy. This was a good buy. Next up is a 2-tenant office building transaction, $3.6 million, $120 a square foot, 8% cap rate. This is one of the larger retail transactions that Reggie mentioned, $12.2 million. This is a big sale for Sioux Falls. $250 a square foot, 6.8% cap. We're going back out to the east side, $3 million transaction, $300 a square foot. Now, that is a bet on the continued strength of the retail market here in Sioux Falls. Right now, it looks like a pretty good bet, but only time will tell for sure. 7.2% cap rate. Kings Crossing. I think this was one of the better buys in Sioux Falls last year. $4 million transaction, $123 a square foot, 8.43% cap rate. That's a great buy. Okay, as we stand here in 2016 and all of 2016 and all of 15, there's very few investment properties on the market. Most of these transactions that you saw happened off market, meaning a buyer approached a seller and said, "Hey, would you sell?" I want to caution sellers out there not to leave money on the table. There's a lot of motivated buyers out there right now who are taking advantage of low interest rates, and quite frankly, you might want to run your property past a couple of buyers before you make the final decision. It's one of these strange times where it's a good time to buy with strong fundamentals, and it's also a good time to sell. I do want to know if you're tax sensitive as a seller. It's hard to find a 1031 exchange. It's hard to find a replacement property. So if you're tax sensitive, make sure you have something lined up if you do indeed decide to sell this year. Sales volume report card in 2015, sales were just great. I mean, they're up across all asset classes, and as we stand here in 2016, I'm predicting more of the same. There's just really nothing going to slow us down at this point. Cap rates for these transactions will remain between 7 and 8%, 7 and 8% for multifamily, 7 and 8.5% for office, and between 6 and 8 for retail. We're going to take a look at the real estate cycle again. And real estate, the reason we do this at the end of every section, we know real estate goes up and it goes down. In terms of sales, I have to put multifamily in hyper supply, which isn't great news for everyone out there, but we saw some fundamentals decline a little bit with that big vacancy rate jump. So I'm putting multifamily in hyper supply. Office and retail, you heard from Reggie and Andy, fundamentals are great, and I'm putting this firmly in the expansion stage of the real estate cycle. Thank you very much for coming. With that, I'd like to bring Michael Bender up to center stage.
Well, there you have it, guys. That's another market outlook in the books. We again hope this is good information for you as you make decisions in 2016. We hope it's a prosperous year for you. I do want to acknowledge one person up in the booth there, Summer Hoffman, our Director of Research. This is her 17th year doing the market outlook, and you can go on vacation now. So that's it. You're adjourned. Thank you.